Let's go live to Martin Place in Sydney. Our business reporter Ed Boyd standing by outside the RBA. Ed, you're with the St George Chief Economist, Besa Deda. Over to you.
Yes, thanks, Kieran. Yes, I'm here in Martin Place with Besa, the Chief Economist at St George Bank, and we had a cash rate increase today, Besa. A bit of a surprise. 10 out of 30 economists were not expecting the interest rates to go up, but they've gone up to 4.1%.
Look, they certainly have, and Ed, we knew it was going to be a close call. After last week's monthly inflation report and also the minimum wage decision, we knew that there was upside risk to a rate hike today, and that's exactly what's happened.
Where do you expect, is this the limit for the cash rate, or is it going to go even higher? Now, we've had that Fair Work decision last week, raising the minimum wage by almost 6% from the 1st of July this year.
Look, we think this could be a peak, but I certainly wouldn't put my hand on my heart and say it's the peak. And the main reason for that, Ed, is that inflation remains very elevated and above the Reserve Bank's 2 to 3% inflation target band. And the RBA doesn't expect inflation to return to that band until the middle of 2025, and even then, only to the top of that band. So that's more than 2 years away, and that means there is some risk that we might need to see more tightening, particularly if inflationary pressures remain sticky.
One thing that we've heard about quite a bit over the past few months is a wage price spiral. Governor of the Reserve Bank, Philip Lowe, is going to be speaking tomorrow in Sydney. How concerned do you think he is with a wage price spiral in Australia?
Look, I think his main concerns around the fact that nominal wages growth is rising at 3.7% per annum on the latest numbers amid very flat productivity growth. So he has spent quite a bit of time, for example, in front of Senate estimates last week, talking about the fact that unit labour costs are rising rapidly. And so I think that is where he will spend his attention on, and I think that is a source of concern for the RBA and also possibly a factor behind today's decision.
But if there is a wage price spiral, what can the Reserve Bank actually do? Does it just mean they need to lift rates even more?
Look, we don't think there will be a wage price spiral, but certainly if there was a wage price spiral, that would contribute to overall inflationary pressures in the economy, and that would mean that the RBA has more tightening to do to bring down inflation.
This week we also get the March quarter GDP numbers. What are you expecting for economic growth in the first 3 months of this year?
We do. We think that the accounts will show that the economy has slowed, and so we're looking for gross domestic product, which measures the pace of economic activity, to rise by just 0.2% in the quarter. Now, that's our central forecast because there is a risk that we see a fall in GDP. And just like today's decision, I think it will be a close call as to whether we get a small positive or a contraction.
So how big a risk now is a recession for Australia, 2 negative quarters of GDP growth?
Well, I think the path has become a lot narrower. The Reserve Bank Governor talks about this path of bringing down inflation while keeping the economy on an even keel. The higher the cash rate goes, the harder it is to stay on that path that is narrowing. If we have a look at the Australian 2 to 10-year yield curve, that's actually inverted. It inverted at the close for the first time since the GFC on Friday. Now, that's usually when you see an inversion that's sustained and extended, that's an indicator of a recession. So I think the possibility of a harder downturn has shortened in terms of the odds after today's decision.
And another indicator of a recession is a high unemployment rate. But here in Australia, it has lifted to 3.7%, but it still feels like unemployment is incredibly low.
It is incredibly low. When we think of unemployment, one good way to think of it is what's that unemployment rate that's consistent with full employment in the economy? Because at any point in time, there are people between jobs or in seasonal employment, for example. And full employment is considered to be with an unemployment rate of 4 to 4.5%. So a national rate of 3.7%, whilst it's off the low point of October last year, is certainly still very low and below full employment. We do think it'll gradually move higher. Demand is slowing, and also you've got that injection of labour supply from the rapid rise in net overseas migration.
The other thing we've seen is central banks all over the world continue to raise interest rates, the UK, New Zealand, United States. Do you think we're finally getting towards the peak of the cash rate cycle everywhere?
Look, I think we're nearing the peak, and certainly there are signs that inflation's moderating, including in Australia. But I think there are concerns around the stickiness. And I guess to put it into perspective, when COVID happened, the cash rate in major economies were cut to historical lows, and governments through stimulus at the economy to protect us from the pandemic. And collectively, that's the most stimulus we've seen since World War II. And so we're unwinding from that. And I guess there is this possibility emerging that inflation might stay a little bit higher than policymakers would like, or a bit elevated, whilst growth is slowing, which is that idea of stagflation.
And just going back to that Fair Work Commission decision, how significant is that from the 1st of July, the minimum wage increasing by 5.75%? How big an impact will that have on inflation and consumer spending?
Well, on our numbering, we see the risk that that wage decision could add 0.4 percentage points to inflation growth. So we see that, there's a modest lift to inflationary pressures from that decision. It impacts 2.6 million people. Those on the minimum wage, which is 180,000, they also had that level shift. So if you include that level shift, the rise is about 8.6%. The risk that we've got to keep aware of, I guess, is that if it becomes an anchor point for workers more broadly in the economy to bargain for higher wages using that decision as an anchor point. So that's something to watch. But at 3.7% nominal wages growth, at the moment, that's still pretty contained. But as the Governor points out, it's against a backdrop of no productivity growth, and there's some concerns around how quickly public sector wages will grow.
So what's your expectation for wages and inflation by the end of this year?
Look, we think you could see wages grow up to 4.3% per annum, where we'd see the peak before it starts softening. Now, keep in mind that we've seen the low point for unemployment, or at least we think we've seen the low point, because if you have a look at job advertisements or job vacancies, they've started to come down, although from a very elevated level. And so whilst there is some room for wage pressures to grow, we think it will start to moderate once it hits that peak of 4.3% per annum.
Well, Besa, Deda, thanks so much for your time.
Thanks, Ed.
Well, there you have it, Kieran. A bit of a gutsy rates call here from Governor Lowe from the Central Bank, raising interest rates to 4.1%. A lot of people weren't predicting it, but it has happened today. So an exciting day here at Martin Place.